You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Merry Christmas, Happy New Year. This is going to be our holiday edition. Danielle, very nice to have you here. Let's take a look over the past year. Did markets and people just have way too much confidence that central banks could control the economy and markets?
Yes, I would take that answer for 50,000, Jim. I think it's an uncanny epidemic that has swept over people and markets the past 3 years, since really 2011, since QE mania really went full throttle and the global economy began to turn down and the investment banks were running rampant with no meaningful regulation or control. You know, they were manipulating, moving in and out, hoarding, stockpiling, trading financial futures on everything under the sun, increasing the leverage, borrowing in yen, borrowing in U.S. dollar as the currencies were increasing, and speculating in everything else on planet Earth. And what we've seen in the past 6 months, I would say, of the year is those trends in mean reversion. So we've had a weakening of the yen, which has brought people back to other currencies. Also, you've had the U.S. dollar strengthening as a response from people fleeing other markets and currencies, other places like the euro, which has been weakening again. We recently saw some action out of the Swiss central bank to make it so that they were giving negative deposit rates on capital in their banking system because they have been having an increasing Swiss franc in the past 6 months, which is bad for their exports. So everyone is trying to desperately find growth somewhere. And meanwhile, the U.S. dollar just continues to be the place of deepest pots of liquidity in times of trouble and concern, and it just keeps going straight up. And as it does, it pulls money out of everywhere else in the world. So certainly out of the commodity complex, out of energy, out of emerging markets, out of high-yield debt, which has been crashing of late, along with energy shares. So all of that just, is well-deserved, frankly, because it is as I say, the mean reversion of the wild speculative phase we saw leading up into 2011, and fits and starts ever since. But everything that we can track about the real economy has been weakening. Debt aversion has been growing in the regular populace, so the U.S. has been delevering. The all-important U.S. consumer has moved from 130% of debt to disposable income at the peak in 2006 to about 100% today. So they've made some downside work on getting themselves out of debt, but their savings rate is still only about 7%. The long-term average is above 10%. If you look at those trends in Canada, the same thing. Canadians are way undersaved, way over-indebted. Our savings rate actually fell over the last 12 months relative to the year before. It's about 4% today. Again, we're probably going to end up above 10% by the time all this mean reversion process completes. So I think that the last 6 months have been true market forces coming back into markets that were heavily manipulated and jigged. And that's a cleansing, comforting thing to anybody that cares about what's sustainable over the long run. But I think that as we look into 2015, those trends are likely to continue. And I think that's the big difference I would see with the prognosticators today, who basically didn't see any downturn coming. They never do. Didn't see any reason for oil to weaken out of triple digit. Was predicating everything on the assumption of, $100 plus oil, is now into this new camp of thinking it'll stay in this $65 to $80 trading range and that it'll be a short blip that in the new year will quickly rebound. I would be on the other side of that. I think that for all the debt and demographic reasons, the regulation going back towards the banking sector, the movement out of some of these commodity spaces, I think we may indeed see the opposite in the new year.
Well, the U.S. Fed is predicting that interest rates will go up in 4 months. But you very correctly pointed out they have been inaccurate in their forecasts since 2007. Why should they change now?
Yeah, the comedy of errors, I call it, is quite funny, really, but it's also sad because these are actually our policymakers. And if you listen to the FOMC press conference last week when Janet Yellen was speaking, she seemed to actually believe that stuff. I don't know if it's possible. I've long been skeptical about whether the board of the central bank actually believes what it says, or it's simply buying more time for the banks, because everything they've done in the past few years has been to allow banks to recapitalize or reprofit, boom up their profits once more after the epic bailouts in 2009, 8 and 9. So I don't know for sure if she believes what she said, but if you were listening to it, it was pretty funny. First of all, she was saying that she thinks that, we're going to get robust growth again, recovering in 2015. They've made that call every single year, and every single year they've been profoundly wrong, by about 50% off what the actual growth has come in at. And I think that the party line is that they're going to start raising rates sometime in the first quarter, perhaps even March or April. They're going to start tightening interest rates in America, is their currently stated plan. And they point to things like the fact that energy prices are lower as the wind at the back of consumers, which they say will pull the economy out of this slow growth phase into a better growth phase. I think to believe that is to believe in fairies, to miss the whole fact that the primary growth, indeed nearly the only growth sector of the past 6 years as we've had this so-called recovery, has been the energy patch. So, without the job gains that were created in the oil and gas sector in both Canada and America, you would have essentially had a recession throughout this period. You would have had no actual growth in the economy. You would have had no job creation. So it certainly has bought us an extended period of cash flow. The trouble is that if that is now mean reverting, you're going to see layoffs in those same hot sectors. You're going to see a cut in the capital expenditures that were driving CapEx over the past couple of years out of that sector. There's some statistics to suggest that for every job in the oil and gas patch, you've got about 3 jobs in other sectors, finance, government, construction, and we're already seeing a fall off in mortgage applications, which recently went to a 20-year low in the United States. Even though mortgage rates have been falling, Jim, the applications for finance have been dropping. The new permits for oil wells have been falling dramatically. Construction permits have been falling dramatically. I think these things are in recognition of the fact that the consumer is still heavily indebted and is committed to working down the debt level. I think Canada is way behind the U.S. in that, but I believe we too shall find religion in this regard. We have done such crazy things with our fiscal state in the past few years that I think people are feeling the stress and strain of too much debt, even at low rates. And now if they're facing a fresh wave of job loss, coming out of this slowdown in the energy patch, which I can't see any other way around it. Perhaps people are going to come home at Christmas and think that they may get laid off for a couple of weeks and they'll be called back in the new year, or called back, shortly into the first quarter. I actually think that's not likely. If so, I think that companies will be in denial for a while, perhaps hoping that they can continue projects that have already been committed to. But the math is really quite severe. When you have a decline, I was looking at the break-even prices for all of the major producers, countries, companies, areas, and prices currently in the $50 range for oil is quite difficult for many of those producers to make ends meet. And so, again, if we're correct and the secular support for oil is about $40 a barrel, Jim, for 20 years, oil traded in a range of about $10 to $40 a barrel, all the way into 2005, when we know that the consumer credit bubble went nuts in the United States and the subprime issuance allowed a whole bunch of spending that was not actually affordable. That's when you saw the price of oil break out above that $40 range and, went to 148 at the peak in '08 and then crashed back to 37 and change, which was the secular top end of the secular support, and then rebounded quickly with the QE speculation and the carry trade that went on over the past 3 years. But now as it's broken decisively through the bottom end of that secular channel, we see that it may indeed be headed back into that $10 to $40 range, and it may indeed spend a few years in that range. So you can just imagine the people that are banking on a quick rebound or this being a short blip, or indeed that lower gas prices are going to spur all this consumption in the economy when 70% of the people that are being surveyed are saying, yeah, lower gas prices are going to help me. They're going to help me pay down bills and debt that I already have, not spend more. So you've got, if you look at what's driving GDP, you've got governments trying to retrench and not spend as much. You've got business now slashing CapEx, and a third of it was coming from the oil and energy patch. And then you've got the consumers still trying to pay down debt. With the rising U.S. dollar, you've also got a weak export picture each time that the U.S. dollar strengthens. So all those things together, I just don't see where one can realistically come up with a strong rebound story for 2015.
We'll have more with Danielle Park right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to Danielle Park, editor of the popular blog Juggling Dynamite. Danielle, boy, what a negative picture we've had painted for us. Is there any little light, any glimmer out there for somewhere somebody could grab onto or walk towards?
Well, you see, Jim, I actually see this as positive development. I know that people like to think that things can only go straight up and that growth can only improve and that people can continue to add on more debt just to keep the ball rolling. But actually, that's a path to nowhere good, right? That's an unsustainable idea. So what I see happening in this phase is actually a healthy thing. It means consumers are going to go back and try and build up some fiscal strength again. It means people are not going to be enticed to spend. They're trying to actually figure out ways to spend less. It means that, it's not good for people who have tied their ship to the demand for, insatiable demand for energy story, because, I was reading an article about Fort McMurray, and they were talking about how people were wanting to know, that they could count on their $1.5 million houses retaining their value over the next decade. I think this type of stuff is la land. It's to completely miss what's been driving the forces of energy price increases the past decade. It's to completely miss that, we had a good run, there was great cash flow, but it's now time to rethink some of those models. So people will probably have to come back from the West to other parts of Canada. They'll have to find other places to work. They may have to retrain. They may have to sell overpriced assets and pay down debt. It's going to be perhaps a humbling period for people who have been living beyond their means and living with unreasonable expectations. But ultimately, it is the path back to fiscal strength, and it is, I think, a necessary catalyst to force some important maturity that needs to happen, for example, in the Canadian economy, in the Canadian government, who have been, riding the wave of lots of cash flow as the commodities boom went skyward, and are now having to quickly realize, hopefully, that their expenses are higher and that their revenues are declining. So it's again, it's not particularly dark so long as you have not been spending your brains out and got yourself heavily levered here. Even if that's the case and you weren't prepared for this, then I think there's wonderful lessons that can be learned from this. And people are very much capable of changing their behavior once they hit the end of the road, so to speak. Once you get to the end of credit, once income stops, people do have to go back and change, and they usually do, and they're better for it in the end. So, the other thing I think that has been such a negative in this period, and I'm hopeful is about to get better, is that the financial intermediaries, the investment banks, have been such a scourge on the face of humanity. They have been, using and abusing every part of the political and any system they can rig in their favor. They have done so, and it has been at the cost of the real economy and real people. There's no question about that. If you look at, I was just writing about this actually, the financial derivatives space, from 2005, when I'm talking about the consumer credit bubble going skyward and all the subprime debt that was issued, if you look at a chart of the futures volume of commodities futures that were traded, financial products based on hard assets that were traded from 05, into 2011, it's like a parabolic chart, Jim. It goes straight up. Meanwhile, demand for those products was falling and production was flat. So it had nothing to do with actual supply and demand. It had everything to do with financial intermediaries being allowed to run wild in the space, trade off of each other, send prices up, stockpile, hoard, hold things back from price discovery. And in doing all that, they created a lot of bad investment decisions, right, by people who are trying to follow the price for a signal about what demand was like. And that really caused a lot of harm to a lot of people. Overinvestment in certain sectors because they thought, a price that supply and demand was dictating a price at a certain level when in fact it had nothing to do with supply and demand. So as the air comes out of that bubble, as the hard assets decline, as the selling picks up, you're going to get a crushing out of many of those speculative forces. And that too will be a positive thing because they were doing no one any good. They were a tax on the system. They were causing a lot of malinvestment. And to get that out of the way will also be an enormous plus for the whole world, frankly. And hopefully it will be the end of an era. As we look back, I'm hopeful that 2014 will mark the end of the financialization era for some number of years when people will realize that that was a very destructive period and that we have to do things differently going forward. And I think 2015 is the next opportunity. We had the opportunity in 2008 when the truth came out, when the genies were revealed as frauds. We had the opportunity then to take stock, clean house, and start fresh. Unfortunately, the powers that be did not take that bit in their teeth. They let the bankers go back to running the show, and we're now paying the price because here we are 6 years later with the same problems.
I was just going to say both the Canadian and U.S. governments have enacted legislation that will let the banks, if they go sideways, dip into your bank accounts to balance their books.
Well, you see, this is the misunderstanding. This was always the case, you see.
But they've just made it really, really official now.
Well, no, but it's because we went through this phase where people were so oblivious to the way risk works in banking systems. We always were vulnerable as depositors. The difference was that when there was robust capital buffers in place, before the financial crazy period hit in the middle 2000s, before they let banks take all their capital buffer out and do all these speculative crazy trading things, there was always levels of capital that had to be maintained in there, senior bond holders, different levels of creditors, equity holders. Everybody was in there with capital at risk in advance of deposit holders. And it was only once all those people had lost money that you ever got to the haircuts coming to deposit holders. But we have to get a system where everybody feels the weight of the risk on themselves. And that goes for depositors. It goes for investors. The past few years, people took the mentality that they should never take any loss. Even if they'd made a bad investment decision, even if they had not done their due diligence and they were, facing a loss, the government should bail everybody out. And that was a very dark period because now we've wasted an awful lot of good money after bad. And we are in a period here where revenues are falling and we could use some savings or buffer or strength to draw on. But unfortunately, we're at zero interest rates all over the world and we have already central banks with bloated balance sheets, so there's very little help to be had here. Now that can be harsh, but it's also, as I say, a good thing, because then we won't have the ability to fall back on further lines of credit when this next crunch comes. And that will hopefully be the catalyst to actually get some change, which really desperately needs to happen.
Would we ever see in Canada and the U.S. legislation like they have in the U.K. now, where if the CEO of a bank allows it to go bankrupt, he can go to jail for 3 years?
I think that there is likely to be more draconian legislation come in. I think of after the tech bubble burst, how, Sarbanes-Oxley came in and there was a move afoot where CEOs had to sign off personally on financial statements to say that they were aware of what was in it, that they followed the audit, that they, knew it was correct and that sort of thing. And of course, that caused a huge hoopla, but that was actually the right approach. We have to stop letting risk takers take upside and leave downside for everybody else. You want to make the big bucks, you want to take investment risk, you have to be prepared to lose money. And when people get that back in their bones, that they personally, reputationally, financially are on the stick for anything that goes bad, that's when you get accountability and strength back in the system. So I think that's actually, I do think we're headed towards that. I don't know about, I'm not in favor of a policy that just says everyone goes to jail if they go bankrupt, because there's lots of factors involved. But there should certainly be a loss of financial principle. There should certainly be clawbacks of bonuses. There should certainly be, a lot of other things that people should be fired, for example. They should not be given these massive, golden parachutes out for bankrupting a company. So, I think we've had these periods in history before where things went this way and it was universally bad, and, out of the ashes comes new thinking and new policies. And I do think that we're overdue for that now.
Danielle, thank you very much for talking to us, and best for you and yours and everyone that you know and love, and everybody else who's listening to us right now on our special Christmas New Year's Eve edition.
Happy New Year to you too.
Thank you very much. My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. We also have a YouTube channel, Talk Digital Network. You can forward comments to the show to info@HowStreet.com. Merry Christmas. Happy New Year's, everybody. I'm Jim Gotti.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.